The Oklahoma City Maps Investment and Operating Trust meeting of February 21st, 2022. Item 2 on our agenda is the approval of minutes. Excuse me. We have both the minutes from the November 15th, 2021 meeting, special meeting, as well as January 11th, 2022 workshop. So I would take a motion for either or both of those approval of minutes. Okay, we have a motion and a second. Please cast your votes.
I have to vote aye.
Okay.
Verbally.
Give us just 1 minute.
Do you want to just verbal vote for this one?
She's in. Someone help her.
Yeah. Okay. Motion passes. Thank you. Okay. Moving on to, was that A and B? Mm-hmm. Okay, so moving on to item 3 on our agenda is items for individual consideration. So first is the investment policy of the trust, and we have Doug Anderson from & Consulting here with us today. Good morning, Doug.
Good morning, everyone. First item that we will discuss today is the investment policy statement, which we have reviewed extensively, both in workshops. And the one piece that we were waiting for this meeting to complete the investment policy statement was the asset allocation. If you go within that document, you will see the target asset allocation has been integrated in that. I do not have the exact page number of that. Page 9, thank you, Brent. The page 9 shows the target asset allocation. As discussed, remember we met the first time and we reviewed 5 target asset allocation models, reviewed all of them quantitatively and qualitatively. And then this one is what we referred to at the time as Model 2.5. So it was a balance between Models 2, Model 3, and you can see that allocation on page 9.
Okay. Any questions for Doug? Okay. If we have none, I take a motion and a second to accept the investment policy as presented. Oh, whoops. Okay, we have a motion and a second. Please vote.
I vote aye. Still trying to get logged in.
Joanne, are you in?
Oh, never mind. I'm sorry.
Great, the motion passes. Thank you. So moving on to item 3B, it's to select the passively managed large cap, mid cap, small cap, domestic equity funds. Doug?
Thank you, Madam Chair. This is an extensive, well, first, congratulations. We got the investment policy statement done.
Yay.
That's something we should all be very proud of. We're moving quickly, yet diligently in this process. So now we have the investment policy statement set. We have our target asset allocation set. Now we need to populate those slots or mandates, if you will. So the first set of those mandates are our passive exposures. And what we've talked about is having passive domestic equity exposure for large cap, mid cap, small cap, and then also international equity passive exposures. So these are market tracking benchmark portfolios or passively managed portfolios. We reviewed several options for each of these. The 2 main contenders for passive management in today's world are Fidelity and Vanguard. They're both very low cost. There is a race to the lowest fee possible, but they also track their benchmarks extraordinarily tightly. So this may sound slightly odd, but the ones that we wanted to choose, or the one that we recommend, for the large cap domestic equities, the Fidelity 500 Index. It tracks the benchmark. Very low cost, 1.5 basis points cost per year on that one. The second one that we want to recommend is the Vanguard Mid Cap Index. All the ticker symbols and everything have been listed and shown. That is 5 basis points, so it's a little bit more expensive. And then the small cap is the Vanguard Small Cap Index International at 5 basis points. Taking a look at the benchmarks that these two funds track compared to the Fidelity, these are more attractive from a risk-return standpoint. They track different benchmarks because the companies define which benchmark they are. They're both mid-cap, and this is the way that we wanted to go on these. So net of fees are the performance comparisons that we always show. And then the final index fund that we want to recommend being retained is the Fidelity Total International Index. That is 6 basis points, but again, it is very low cost, tracks the benchmark that we want it to, and actually does it for smaller expense than Vanguard. So to go down that list again, Fidelity 500 Index for large cap, Vanguard Mid Cap Index Admiral for mid cap, Vanguard Small Cap Index Admiral, and that refers to the share class, for small cap, and then international equity, the Fidelity Total International Index.
Okay. Any questions for Doug about any of those recommended managers? Any questions? Okay. We can go ahead and do B. Let's go ahead and take those separately since they're separate on our agenda. So a motion and a second. Okay. All those or cast your votes. Okay, the motion passes. Thank you. Item C, so the passive managed international equity fund recommendation is Fidelity Total International. Take a motion in a second. Cast your votes. Thank you. That motion passes as well. Okay, so moving on to item 3D, the core fixed income fund.
Good, thank you, Madam Chair. So you may ask yourself why we want to do active management in fixed income but not in equities. And the bottom line is that we are in a very transitional market environment, one that is more conducive than normal for fixed income, but I think that fixed income really is a place we like to see active management. Over time, active managers in the fixed income world are much more consistently able to outperform their benchmark on a net of fees basis. Actually, can we give,
Yes.
Mitchell, can we get to that? Are we doing high yield first or core?
Core fixed.
No, we're skipping that. Yes, we're instead of doing the core fixed income passive management, we're going to skip that.
Okay, so we're going to the active managed high yield.
Absolutely.
Oh,
Thank
okay.
you. Sorry for the confusion.
That's okay.
Sorry for the confusion. So if we think about the bond world is one where it's not a market, it's, let's see, yes, we're good there, thank you. It is not a market like the stock market is, but it is a universe of dealers. There are many, many reasons that it is easier to outperform on fixed income. We don't need to go into those today, but what I would like to say is that in an environment where interest rates could be changing rather dramatically, where we have inflation as a worry, where we have things that could be different going forward than they have in the past, I think that it's much more conducive for our long-term success to have actively managed fixed income. What we are talking about in dollars at an $80 million contribution level, right, for the high yield portfolio is going to be $4.6 million, the initial allocation. So I always like to state that. When we go out to, I had $110 million as the 80 and then 30. We're looking at $6.3 million at that time. So as we talk about fixed income here, we're going to start with the high yield, which is I would say that it's a nice word for junk bonds. That's what we used to call them in the old days, but these are bonds that are rated below investment grade by the major rating agencies. Should that be concerning to you? No, I don't think so. I think that the high yield bond world is much stronger than it was 10 years ago. I think that the underwriting is much better from the investment managers, and I think the ability to provide additional yield is important. When we look at the high yield bond market right now, from a very high level, the yield is about 5%. It can be much higher than that at certain times. But what we are talking about is a part of the bond market that has slightly more risk to it than government bonds, because these are bonds issued by companies. Companies can sometimes run afoul, but it's a much safer world than it has been recently. Could you go to the following page, please? Here are the fees. First thing that we always show when we're talking about managers are the fees. So these are 3 mutual funds. It is unwieldy to have an actively managed separate account in bonds until you get around $100 million. I'll show some of those figures in a few minutes. But these are the 3 managers that we recommend taking a look at and hiring one of these today. So those are what's called New York Life is the firm. That's Mackay Shields is the underlying manager of that portfolio, which is wholly owned. Payden and Regal is a West Coast-based firm, but Payden High Income Investor Class. And then PGIM High Yield Fund Class Z. One thing that you'll notice a lot in the bond world is that insurance companies are some of the larger players in the business because they have to invest in bonds and do so very, very successfully for themselves. If we could move on to the page, it's firm and investment option information. That's the one right there, thank you. If we look at some high-level points here, so we have New York, mainstays based in New York, of course, New York Life. Payden is in Los Angeles, and then PGIM is in New Jersey. If we look at this, 2 of them are subsidiaries of larger companies, being New York Life and Prudential Financial. Payden is independent. If we look at ownership there, we have 0% ownership for the 2 insurance-related organizations and 100% for Payden. We'll look at, on the next page here, a few items. Strategy assets under management, which is about 2/3 of the way down the top table there. So 30 billion, 30 billion, and 37 billion. So these are large investment managers in the asset category. You will see that the percentage of firm assets in the strategy is important, I always think. So 19% for Mackay Shields, 4% for Payden, and 4% for PGIM also. So there are some construction information on how these groups put their portfolios together. Relative value is the name of the game. They want to buy bonds that are more valuable than the market is pricing them. So they're looking for cheap bonds out there, and I think that it's something that most firms with good research can do. If you look at the duration constraints here, most of them keep it relatively close to their benchmarks. So they're not taking a lot of interest rate risk. They are focusing on credit risk. Interesting to see here, if you go down on that second table, the typical number of holdings, it's about halfway through, 350 to 550 for Mackay Shields. The next one is 300 to 400, and then PGIM is 500 to 700. So what you see, these large portfolios, they have to own a lot of bonds. And once they buy these bonds, sometimes they do not ever sell them. They hold them until maturity. If you'll see the turnover here, it's relatively low, so 25 to 45. Payden is higher at 50 to 100% turnover for a year. That means they're holding the bond for 1 to 2 years on average. And then the PGIM high yield is 40% turnover, so that means over a 1-year holding period. I think the next page gives us a few figures, and then we'll go into performance. Again, trying to get an idea of what the portfolios look like and how the firms feel about or manage the portfolios. So you see on the statistics section here, duration. And duration is dollar-weighted maturity. In the bond world, the primary factor of performance is interest rates. So when interest rates go up or interest rates go down, it has the opposite effect on bond prices. What this duration figure tells you is that for every 1% change in interest rates, either direction, that's how much these portfolios value changes in the opposite direction. So if we had the interest rate for, say, the Mackay Shields, their duration is 3.2. Interest rates go up 1%. The value of this portfolio will go down 3.2%. All right, so it gives you a way to compare all of these, one versus the other, on how they react to interest rates in their current structure. This can change somewhat. So if they go, interest rates go, if they go down 1%, it's the opposite reaction. They go plus 3.2%, plus 3.95%, and plus 0.4%. You can notice on one thing here, the average credit quality. So AAA is the highest. C is the lowest, except for defaulted bonds, and we don't want to think about that today. But triple B for Mackay Shields or Mainstay, single B for Payden, and single B for PGIM. So that means that the highest relative credit quality for all of these is going to be the Mainstay. And remember, we're trying to show different types of managers here. I am going to jump ahead to performance, though, because at the end of the day, we want to see how these funds perform versus each other. One more or a couple more. There we are, right there. This is a trailing performance analysis as of 12/31 of last year, so this goes all the way through the end of last year. What each of those dots represent in each of the columns is a return of one of the funds versus their peers. So the boxes or the columns show you from the 5th percentile to the 95th percentile of high-yield bond funds, right? So the 5th percentile is going to be at the top, the 95th is at the bottom, and what we really want to see is we want our managers to be in the top quartile. You can see that over the short term, there can be some volatility, but as we go all the way out to the right-hand side for the 10 years ended December 31, this is a compound annualized rate of return. You see the return of the investment managers, and they are very close to the top quartile, I mean top 25%, if not in the top, close to the top third. One thing to note here, it is very difficult for bond managers in this part of the market to outperform that benchmark below. And that reason is that benchmark, if there is a downgrade for a bond by credit quality, those bonds exit the portfolio at the market price, which makes it incredibly difficult for an active manager to outperform over time. In effect, that the benchmark itself kind of has a free pass for downgrades in the portfolio. Now, that being said, on the equity side, we had passive alternatives that we could invest in. You can't go out and buy this benchmark. That's the problem. So that's why we have to try to keep up with it, but we're not able to invest in it, because that would be a pretty easy decision if you could go out and find this, but it's not possible to invest in it because of that construction quirk. So as we're looking across this, for the last 1 year, everybody's pretty tightly grouped together in between 535 for Mackay Shields or Mainstay all the way to 662 for Payden. So looking out over the 3 years, we have one that's a double-digit rate of return, which is really nice when you're thinking about bonds over the last 3 years. So we have the highest is Payden, the second highest is PGIM, and the third is the Mackay Shields. Over the last 5 years, you can see that PGIM and Payden are very close to one another. Mackay Shields at 5.72. Over the last 7 years, you can see 653 versus 606 and 603. And then all the way out over the last 10 years, you can see PGIM is in our first one in the clubhouse, and then you see Payden, and then Mackay Shields. So what I would say is if we're looking at all of these, and I'm going to go for one more slide here if I could. I'm going to do a relatively large page flip all the way to the one that's entitled MPT Statistics. Keep going. There we go. If I could go to the next one following. Well, that's perfect right there. Thank you. So what we're looking at here is a variety of performance statistics for each of these. And again, this refers to the same period. These are all net of fees. But one thing that I'm especially sensitive to with the returns we're trying to produce here on a consistent basis is at the bottom of each of these tables. And it's called an up capture and down capture ratio, right? And then also slightly above that is the batting average. So first up capture and down capture. When the market is up during a month, a calendar month, what this up capture tells you is how much of that return this bond fund, on average, has achieved, right? So an up capture of above 100% means that they outperformed to the upside. If it's below 100%, that means they didn't go up as much. Now you combine that with the down capture ratio, which is the mirror image of that. Months that the market is down, the bond market is down, how do these funds perform? So if it's above 100, that means it's going down more. But if it's under 100, that means it's going down less. So what I like to do is I like to compare these up-down capture ratios. And I'm going to go all the way to the 10-year, which is the bottom there. And when I'm looking at this, I see the mainstay portfolio, 87% upside. So market's up, it's not up as much. Market is down at 81, it's down less, right? So you have a more compact range of returns for that fund versus the market. Paid-in at 95 or 96 versus 98 means the market goes up, it's almost as much, market goes down, it's almost as much down. I don't like that ratio, though. I like to have more upside to downside, which is the case on the first fund. And then on the third one, there you see the PGIM high yield. So 99% of the upside, 93% of the downside. I like that profile. That's my favorite. One more thing to look at on that is for the 10-year, if you look at the batting average, so that is month by month, does the fund outperform its benchmark? And you'll see here that the batting average, this is out of 100%, you see 43.3 for the first one, paid-in, the second one, 52.5, and PGIM at 55%. So what that tells us is that we outperform slightly more than average, which is good. That's not a bad thing. That's good if you can do it slightly more than average. When the market is up, at least on the last 10 years, it's up almost as much. When the market is down, it's down not quite as much. So 99 versus 94, I like that ratio of upside to downside. And the one last thing to remind ourselves of on this one are the expenses, and that's all the way at the beginning. So the expense ratio for New York Life, or the mainstay, is 60 basis points per year. Paid-in is 63, and PGIM is 50 basis points. So that is a long version of these three funds and the role that I see them fulfilling, one of them fulfilling in the portfolio.
And I would offer, with as many pages as we skipped, that was probably a brief summary of the presentation. So no, appreciate all of that information. So questions for Doug?
Can you talk about the beta between the portfolios? Obviously, with lower betas, you're going to have lower risk. Hence, the up and down captured dispersion on, I guess that'd be the Mackay Shields.
Yes.
And versus the PGIM, which has a beta of 1, which is roughly the market. So just, can you comment on the three differences there?
I can, and I want to pivot off of that slightly. So beta is a regression statistic, right? So you take all the returns over time, and you say, okay, well, upside, downside, how does this portfolio react in order of magnitude versus the benchmark? So the market benchmark is a beta of 1 when we're looking at this. PGIM 1, paid-in 0.98, so it's less, just by a little bit. And then Mackay Shields at 0.87, so it's pretty significantly less. I think that is what I want to make sure to do is cross-reference that with the standard deviation, right? So the volatility, the raw volatility of returns, not a regression statistic, it holds about the same. So 6.6, 6.62, and 5.78, right? So it's telling us that the same pattern for the beta holds for the other. There is definitely, Mackay Shields is definitely much more or much less volatile, but I think that the lower batting averages sort of sways me away from that. I like them. I like all three of these teams quite a lot, but I think that looking forward, I don't know if that same sort of lower volatility really helps us, because I think that over the next few years, we might see interest rates going higher, and want to have some aggressive exposure to that looking forward.
Thank you.
Thank you.
Other questions? Brent, Bob? Okay. So we need a motion. Does anybody have a preference or a pick, somebody that they'd like to, because we need to pick one of these.
If I were choosing today, I'd make a motion to select PGIM just based on, I'm sorry, what was the other one? The paid-in high income.
Paid-in.
Pardon?
Paid-in high income would be my
The PGIM was the one, the PGIM was the one that I was,
Oh, okay. Sorry about that.
the names are similar.
Right. So,
I'll make that one.
Okay.
Or I'll second it.
motion and a second to select PGIM as our high-yield fixed income manager. Any other discussion? Questions? Okay. Oh, well, please cast your votes. Just doing this once a month, it's hard to remember all the technology. Okay, the motion passes. Thank you so much.
Thank you.
Okay, so now we're moving on to item F, select an active manager for the core fixed income funds.
Thank you, Madam Chair. So again, at $80 million, the initial allocation, our target for this, and this is our first step into active core fixed income. I anticipate another one within the next 6 months, but this is a $22 million allocation, so significantly more. This is a big part of our portfolio and one that is going to be important going forward. So we're going to go through the same structure of the reports. This one we have 4 managers to consider. You will see on the first page there that these are all mutual funds. Again, mutual funds are the way to go in fixed income until you have a very large portfolio because it's very complicated in many cases. Lots of securities. This is the cost-effective way to do it. And remember, the manager that we just hired had an expense ratio of, I believe, 50 basis points. These are less expensive. It's a less specialized asset category. So as we go down the list here, Baird Advisors is one. The management fee there is 30 basis points. Dodge & Cox, 42 basis points. Goldman Sachs at 38, and then Harbor, which is sub-advised by Income Research and Management at 26 basis points. So you can see that there is some difference in the fees here, but all the returns that we show are net of fees also. So core fixed income, what is core fixed income supposed to do? It's going to invest in investment-grade bonds for the most part. It's going to have very little exposure to high yield like we had. It is a portfolio that is going to be sort of the S&P 500 of our bond allocation. So it will be the most or the largest allocation within bonds. We can move to the firm and investment option information. Thank you. You will see that these firms are all mature. Baird is the newest one. It was founded in 2000. But this team has been together prior to that. Dodge & Cox was founded in 1930. Goldman Sachs in 1988. This is the investment management group. And then Harbor /IRM was in 1987. You can see their locations are a little bit unique. Milwaukee, San Francisco, New York, and Boston. One thing about bond managers, they don't all have to live in New York like they like some of us think that they used to have to, because it is a very interesting investment. And I'll say that the personality that it takes to manage a bond portfolio is somewhat unique also. If you see the firm assets under management, they're very, very large here. 130 billion for Baird, 371 billion for Dodge & Cox, 2.2 trillion for Goldman, and then 95 or 96 billion dollars for Harbor in the IRM. You'll see employee ownership for 3 of these is high, 95, 100%, and 89%. 3 of them are independent, right? So we like that, but it's not necessary. And then Goldman Sachs is, of course, owned by Goldman Sachs. You'll see the committee members, the number of portfolio managers, and the different ways that they do it. Baird is a group of generalists. Dodge & Cox has sector and industry specialists as far as their analysts go. And Goldman Sachs and Harbor are the same as far as having analyst structure. Also interesting to look at how many analysts each of the firms have. 21, 49, 36, and 33. So these are big, big groups of resources. The next slide shows you a few more things. One of the things that we like here are bottom-up investment management and then fundamental. Most of them do that on the top table. And you look at the duration, the style bias, all fairly similar to one another. This isn't an area where you see a lot of differentiation at the total portfolio level. You kind of have to dig deep to get there. You will see that duration constraint. So this tells us how much the portfolio manager will move duration around as a tool of portfolio management. right? Duration being the single biggest factor of performance in bond portfolios. As I go from left to right, Baird is neutral. They match duration at all times. They do not attempt to predict the direction of interest rates as a tool of portfolio management. Dodge and Cox will. They will move the duration of the portfolio in today's terms about 1.5 years either direction of the benchmark. You will look at Goldman Sachs, theirs is relative, about plus or minus 1 year, and Harbor will also do the same, but plus or minus 0.25 years, so they're very close. When we look at this from left to right, so duration, Baird is completely neutral. They match the benchmark's duration at all times. Dodge and Cox is the most aggressive, followed by Goldman Sachs, and then Harbor moves it, but just by a little bit here. If you look at where they invest the overweight versus the benchmark, you will see that Baird invests in spread sectors, so that's corporates and mortgage backs. You'll see that Dodge and Cox and Goldman Sachs both focus on corporate bonds, right? That's where they focus the most of their time. And you will see that Harbor invests in securitized products, so that's mortgage-backed and asset-backed for the most part. So going through this, I would like to go to the following page here just to get an idea of what the portfolio structures look like. So number of holdings, very large, right? Bond portfolios tend to hold a lot of securities and very small positions, but you will note that Harbor is quite a bit smaller than the others. Assets in the top 10, so this is the top 10 bond holdings that they have. Baird has 27% of their portfolio in that. Dodge and Cox has 22, Goldman has 13, and Harbor has 16.9. So relatively diversified even at the top end of the portfolios. And then in the statistics sector here, section of this table, the duration and credit quality, those are the two that I always like to point out. So we're going to call it a draw on average credit quality. It's all A on all of these. That is above investment grade. But I also want to point out the duration here. Again, remember this is the dollar value fluctuation of the bonds for 1% change in interest rates. So Baird at 6.7, Dodge and Cox at 5.1, Goldman Sachs at 6.47, and Harbor would be right around 6.7 also. So when we're looking at this, right now, Dodge and Cox appears to be the most cautious from an interest rate perspective. They have the lowest duration, meaning if interest rates do go up, they're going to be down 5% for every 1% rise in interest rates, whereas you look at Baird would be down 6.7 and Goldman Sachs would be down 6.5. So they are expressing a view on the markets through duration that they think interest rates could move higher from here. I'm going to move on a few more slides here to the quantitative review. Again, we're going to walk through this almost the same way as last time. And looking at this slide, you can see for the last 1 year, all of the portfolios were negative. That's what happens when bond yields go higher, right? We don't want to see that, but inevitably that will happen. As we go for the 3-year period of time, you can see that the results are anywhere from the 29th percentile for Baird to the 5th for Dodge and Cox. Again, higher yielding bonds and a lower duration and a rising interest rate environment allowed Dodge and Cox to outperform. When I'm looking at that 1-year return, or remember the duration, those figures are very, very highly correlated with the losses that we saw here. So longer duration means more gains, but it also means more losses in this part of the portfolio. Looking over the last 5 years, returns again, everybody's in the 4% range. These are all net of the fees we talked about, going anywhere from 4.29 on the low side to 4.81 on the high side, and that is IRM and Dodge and Cox. And then over the last 7 years, you can see 4.26 for Dodge and Cox, and then the others trailing that. In fact, going out over the last 10 years, we have 2 in the top quartile. That's Baird and Dodge and Cox, and then we have 2 that are in the top third, 3.86 and 3.84 for Goldman Sachs and IRM. Now on the next slide, I want to show something. This is year by year. It's the same type of performance, but it's not all periods ending 12/31. These are calendar year periods of time. And so there are not a lot of periods where we show losses here. Remember, a bad year in the bond market is down 2%. bad year in the equity market is down 20%. But if we look at the year 2021 there, that is one of the worst years in the bond market in the last 40 years. If you can imagine that. It doesn't feel like that's a tremendous loss, but for the bond world, it was a tough, tough year. So looking at that, and I look at the returns and how those compare to one another. So Dodge and Cox is the highest return or the lowest loss, and then Goldman has the highest, the most severe loss. So I'm going to trace across the line on the bottom where it says the Bloomberg aggregate bond total return. We're looking at this. So when the returns are high, the results are pretty highly correlated. But I'm going to go all the way over to 2013. That's a loss for the benchmark, and I'm going to compare the returns of the funds versus that loss. And it's a similar picture, right? It was a different market environment, but the one thing that I'm, again, especially sensitive to in this part of the portfolio is, are we providing adequate returns on the upside, given that it's relatively modest, but are we also protecting on the downside? And when we look at this, Dodge and Cox stands out by a fairly wide margin. They were positive on that year. So in 2 down years, they're the best performer. Would I expect that in the future? Hopefully, but not, I can't say it's definitely going to happen. But in the 2 years where we saw interest rates rise and bond portfolio returns are negative, one manager does stand out above the others. So I'm going to go for a few more pages here. If I could get to the rolling correlation, that's the one right there, perfect. So this is the correlation coefficient of the portfolios versus the index, right? 1% is a perfect positive correlation. And remember, the bond market is primarily affected by interest rates. So you can see that the blue is Baird on the top one. That's the 3-year, where these are rolling 3-year periods, and the bottom is a rolling 5-year period. So Baird, gray is Dodge and Cox, green is Goldman Sachs, IRM is yellow, and the benchmark doesn't move. It's the solid dotted line at 1% or 1.00. So when we're looking at all of these, highly, highly correlated until 2020 on both of these, but there's one manager who is lower correlation to the market than the others. And again, I don't want to continue to recite this too many more times. I'm afraid of interest rates moving higher in the near term. And I want a manager who is willing to decouple from the bond market through investment strategies. And that table shows us which one of those does that. If we could go to, again, skip over a few of the pages, but go back to the MPT statistics again, the table that has the up and down capture ratio. And I would prefer to go to the 7 and 10, so it's the second of those. That's it, right? Let's see, now it's the other direction. Warmer, yes. One more, please. Perfect. So this is the modern portfolio. Those are the performance characteristics for the 7 years and the 10 years. Now, looking at this, the bond managers, one thing I like to point out here is the batting average on the top table here. It's a lot higher than it was for the high yield bond market. So these managers are more routinely outperforming their benchmark. And if you look on the lower table, it's fairly high also compared to what we just saw. If we look at the up-down capture ratios, again, these all look good to me, right? I like to have a higher upside capture ratio than a downside because that means that I'm sort of getting more of the return with less of the risk. And when I'm looking at these, the ratio, when I divide the up by the down, it's all better than 1, right? I like to see that. When I look at the last 10 years, 116 versus 92, 106 versus 54. Goldman is 113 versus 93, and IRM is 111 versus 88. Those are all very, very good risk profiles. But again, in a transitional market environment, one where I think interest rates could be moving higher, I want to make sure that I'm protecting against the downside. And when you look at this, there's one of those managers that stands out pretty dramatically. And that is the one that has a up-down capture ratio of almost 2, which is almost unheard of when you were looking at very efficient asset categories. Kevin, when I'm looking at the beta for that 10-year period of time, so 104 versus 78 versus 104 versus 1. And then the standard deviation is also quite a bit lower for Dodge and Cox versus the others. So I think I'm happy to take any questions. All of these firms are fantastic organizations, but I think that in a transitionary inflation interest rate environment, I think there's one that hopefully stands out above the others.
Any questions for Doug?
Yeah, I have. Yes. Oh, sorry. I do have one question. I mean, Dodge and Cox obviously stands out above the others to me. I did notice, or you talked about the expenses being somewhat higher. Any concerns with that, or?
Well, I think that, Ed, all things being equal, I would like them to be the lowest fee also, but it's just not. That's their fee. Dodge and Cox they've always been a low fee investment manager. They have 6 products, right? That's it. They have 6. They don't have an extremely wide range of products for their clients, and so they do tend to have, on bonds, they have low fees, but not the lowest fees. If you look at them on the equity side, they've traditionally been lower than average. So I would prefer it to be that way. Does it give me any heartburn? No, because I think they've been able to demonstrate that they're able to. And again, all of these figures are net of those expense ratios.
Other questions? Brent, did you have a question? Okay. Anybody else? Okay. If no further questions for Doug, we would take a motion.
I'll make a motion to select Cox as our actively managed core fixed income fund manager.
Okay.
I'll second.
Okay. We have a motion and a second to select Dodge and Cox as our core fixed income fund manager. Please vote. The motion passed. Thank you so much. Appreciate all your information, Doug. Now, are we going back to item D?
No, we
Which
just
is-
superseded that one.
So there'll be
Oh, got it. Okay. So that one is stricken based on the active manager selection. Okay, perfect. Any other questions for Mr. Anderson while we have him? Okay. Thank you for all your work.
Thank you very much.
It does feel like we're off and running.
It does, it does. This is a good day.
Yes,
Very
it
exciting.
is. Yes, it is. Great. Okay, so that gets us to item 4, reports, comments from the trustees, staff, or interested parties. Do we have anybody signed up to speak today? Okay. Any comments? Yes.
All right, well, good morning, and congratulations on all the activity that took place today between the passing of the investment policy and the managers and the funds. This is an exciting time to really get things running with this trust. Just to give you an update structurally with the MAPS 4 program, during the February special meeting, the MAPS 4 Citizens Advisory Committee did approve $80 million to be transferred to the Oklahoma City MAPS Investment and Operating Trust. That will now go before the City Council, most likely during the March 1st meeting. If for whatever reason that gets pushed back, it would be the March 15th meeting. All that being said, we are looking at March when we get the final approval to get the $80 million into the trust. City staff has been in coordination with BOK, which is the custodian for these, and everything is set. We will have everything ready to go from this standpoint. And now that this trust has approved the investment policy and the allocations, we should be able to do everything we can to let Doug invest those funds on behalf of the trust. Once we have the $80 million invested, everything from a city staff standpoint will move towards looking at our spending policy. That will be come with a lot of input from ANCO as well. And city staff will be in coordination with the chair to make sure to see what the best format would be to bring that before the trustees in hopes that we can possibly look at that at the May regularly scheduled meeting. But if there is another special meeting in between now and then, staff will be in contact with the trustees to get that if a special meeting is required. But that would be the next step from here. So I could take any other questions you might have about what that process looks like.
Any questions for Matt? Yes, there's a lot of interest in the spending policy, so get questions about that regularly. A lot of interested parties in the spending policy.
So once we get the funds, all hands on deck will move towards the spending policy. That's definitely the next step in the process. But getting that $80 million will definitely be a good, exciting first step to get this there.
Great. Okay. Thank you for that update. Any questions? All righty. Thank you so much, Matt. Okay. Any comments from the trustees? Comments from other staff? All righty. Well, seeing none, looks like our business is taken care of, so we are adjourned. Thank you for being here.